Hello and welcome back to MonsterInvest. This is the place where we stop treating the financial markets like a casino and start treating them like the serious, life-changing wealth-building tool they are designed to be. I am your host, Daniel, and I am absolutely thrilled to have you with me today for what I believe is going to be one of our most important episodes yet. Today's episode is special. We are going to slow things down. Usually the financial world is all about speed, milliseconds, high-frequency trading, the 24-hour news cycle. But today we are going to take a deep breath and go on a deep dive. A masterclass, if you will. We are not going to talk about the latest stock that is trending on Twitter. We are not going to look at charts that predict where Bitcoin will be next week. Instead, we are going to look in the mirror. We are going to talk about the single biggest risk to your portfolio. It is not inflation. It is not the Federal Reserve raising interest rates. It is not a global recession or a geopolitical crisis. The biggest risk to your financial future is you, specifically the behaviors, biases, and mistakes you make when you are just starting out. I have titled this episode, Common Mistakes Beginner Investors Make, but that sounds a bit dry. A better, more accurate title might be, How to Stop Setting Your Hard-Earned Money on Fire. To help us understand these mistakes, we are not just going to list them out like a dry textbook. That's boring and frankly, you won't remember it. Humans are wired for stories, not bullet points. So I want to invite you into the lives of three fictional investors, Alex, Sarah, and Ben. These three people represent the three archetypes of beginner failure. You might see yourself in one of them. You might see a friend in another. You might even see yourself in all of them at different stages of your life, and that is okay. The goal today is not to judge. The goal is to recognize these behaviors so we can rewrite the script before it ends in tragedy. Let's start with our first character, Alex. Alex is 25 years old. He is ambitious. He works hard at his marketing job, he saves a little bit of money, and he has a burning desire to get rich, not eventually, not in 30 years. He wants to get rich now. Alex is the victim of our first and most deadly mistake, the get-rich-quick mentality, driven by FOMO or the fear of missing out. Picture this, it is a Tuesday evening. Alex is tired after a long day at work. He sits on his couch, opens his phone, and starts scrolling through social media. He stops on a post from a guy he went to high school with. Let's call him Crypto Chad. In the photo, Chad is posing next to a brand new lime green sports car. The caption reads, "Just made 10x on this new coin in 3 days. Quit my job, to the moon, financial freedom." Alex feels a physical reaction in his gut. It isn't just curiosity, it is a mix of jealousy, anxiety, and inadequacy. He thinks, I work harder than Chad, I was smarter than him in school, why is he rich and I'm still budgeting for my morning coffee? This is the psychological trigger. Alex isn't thinking about business fundamentals. He isn't thinking about cash flow, profit margins, or utility. He is thinking about speed and status. He feels like the train is leaving the station, and he is stuck on the platform. So Alex joins a few online forums and Discord channels. He enters an echo chamber. He sees thousands of people chanting the name of a specific stock or a new, obscure cryptocurrency. Let's call it Rocket Corp. Everyone says it is going to the moon. They are posting rocket emojis, diamond hands, and promises of guaranteed returns. The hype is intoxicating. It feels like a party, a movement, a revolution. And Alex is standing outside in the cold. He wants in. He enters what we call the confirmation bias phase. He only reads articles that say Rocket Corp is going up. If he sees a skeptical article, he dismisses it as FUD, fear, uncertainty, and doubt. He convinces himself that the skeptics just don't get it. Without checking if Rocket Corp makes a profit, spoiler, they don't. Without checking who runs the company, and without checking the history of the price, Alex takes his entire savings account, $5,000 that took him 2 years of discipline to save, and he buys Rocket Corp stock. He buys it at the absolute peak of the frenzy. For the first 48 hours, he feels like a genius. The price ticks up 2%. He feels a rush of dopamine. He opens his calculator app and starts doing the math. If this goes up 10% every week, I'll have $1 million in 3 years. I can quit my job. I can buy that car. But then the music stops. The early investors, the ones who bought in months ago, the ones who actually started the hype, decide it is time to cash out. They sell. Huge sell orders hit the market. The price of Rocket Corp stumbles. It drops 5%, then 10%. Alex freezes. He goes back to the forum. Everyone is saying, buy the dip, it's just a correction, hold the line, so he holds. He might even buy more, throwing good money after bad, thinking he is getting a discount. But the price keeps falling, down 20%, down 30%. Now the fear sets in. The forum that was full of cheering is now full of panic, blame, and silence. Alex is checking his phone every 3 minutes at work. He can't focus on his job, he isn't sleeping. He wakes up at 3 a.m. to check the markets. His $5,000 is now worth $2,500. Finally, the pain becomes too much to bear. The psychological torment of seeing that red number every day breaks him. He tells himself, I just need to stop the bleeding. He presses sell. He cements a 50% loss in 2 weeks. He bought high because of greed, and he sold low because of fear. Alex fell into the trap of treating the market like a lottery ticket. He mistook speculation for investing. Speculation is betting on price movement based on hype and what the next guy will pay. Investing is buying a piece of a business based on its ability to generate cash flow. Beginners almost always start as speculators, and they almost always pay the price. Now let's leave Alex to lick his wounds and move on to our second character, Sarah. Sarah is very different from Alex. She is intelligent, highly educated, and very analytical. She is a software engineer. She doesn't fall for hype. She hates gambling. She trusts data. But Sarah falls into the second major trap, overcomplication and the illusion of control. Sarah decides she wants to invest, but she convinces herself that the stock market is a puzzle to be solved. She believes that to make money, she needs to be smarter than everyone else. She needs to find the perfect system. She spends 6 months just reading. She learns about technical analysis, candlestick patterns, moving averages, Bollinger Bands, RSI, MACD, Fibonacci retracements. She buys 3 different monitors for her desk. Her screen looks like the cockpit of a spaceship or a scene from The Matrix. She finally starts trading, but she doesn't just buy a good company and hold it. She tries to trade the market. She tries to time the swings. She tries to jump in before the rise and jump out before the fall. Here is the invisible enemy Sarah is fighting: friction costs. Sarah ignores the math of taxes and fees. Every time she sells a stock for a profit that she held for less than a year, she triggers a short-term capital gains tax, which is taxed at her highest income tax bracket. Furthermore, she is fighting against algorithms. High-frequency trading bots executed by supercomputers on Wall Street can react to news in microseconds. Sarah is reacting in minutes. She is bringing a knife to a nuclear war. After a year, Sarah looks at her performance. She has made hundreds of trades. She is exhausted. She has stared at screens for thousands of hours. Her cortisol levels are high. And when she calculates her returns after taxes and trading fees, she realizes she is up only 4%. Meanwhile, the S&P 500 index, a boring, passive list of the 500 biggest companies in America, is up 10%. If Sarah had just put her money in a simple index fund and done literally nothing, if she had gone to the beach, learned to paint, or spent time with her family instead of staring at her 3 monitors, she would have made more money and paid less in taxes. Sarah's mistake was thinking that complexity equals success. She suffered from the illusion of control, believing that more data and more activity would lead to better results. In investing, laziness is often a virtue. The more you tinker with your portfolio, the more likely you are to break it. Now let's look at our third character, Ben. Ben is a nice guy. He is conservative. He buys good blue-chip stocks. He isn't a gambler like Alex, and he isn't a day trader like Sarah. But Ben suffers from a psychological flaw called anchoring and loss aversion, which leads to the disposition effect. Ben buys a stock in a solid legacy car company at $100 per share. He believes in it, but then the world changes. Electric vehicles start taking over market share. The company has a massive recall. Management resigns. The fundamentals of the business have fundamentally deteriorated. The stock drops to $80. A rational investor would look at this and say, the thesis is broken. This company is in trouble. I should sell, take the $20 loss, and move the remaining $80 into a better, growing company. But Ben can't do it. He looks at his screen and sees. He takes it personally. He says to himself, I'm not selling until it gets back to $100. I just want to break even. Once it's back to what I paid, I'll get out. He is anchored to the price he paid. The market does not care what Ben paid. The stock doesn't know Ben owns it. The stock is only worth what it is worth today. So he holds. He refuses to sell a loser. Meanwhile, he has another stock in his portfolio that is doing great. It's up 20%. He gets nervous that he might lose that profit, so he sells the winner to lock in gains. This is the disposition effect, selling winners too early and holding losers too long. The car stock drops to 60. Ben says, well, now I really can't sell. It's too low. It has to bounce back eventually. The stock drops to 40. Ben ends up holding a dying company for 5 years, watching his money evaporate. But the tragedy isn't just the money he lost on that stock. It is the opportunity cost. That $80 he left in the dying company could have been invested in a thriving tech company that doubled in value over those 5 years. By holding on to the past, Ben missed the future. He let his ego dictate his financial decisions because admitting a loss feels like admitting he is stupid. So we have Alex the gambler, Sarah the overthinker, and Ben the stubborn holder. Do you recognize any of these traits in yourself? I certainly do. I have been all 3 of them at different points in my life. But there is a fourth mistake that affects Alex, Sarah, and Ben equally, and this is perhaps the most dangerous one of all because it is invisible. It is the mistake of short-term thinking versus long-term compounding. The human brain is not wired to understand exponential growth. We are wired for linear growth. If you take 30 linear steps, you get to the other side of the room. If you take 30 exponential steps, you circle the earth 26 times. Beginner investors are obsessed with what the market is doing today. They watch the news. They worry about the election. They worry about interest rates next month. They treat the market like a TV show where every episode needs a cliffhanger. But real wealth is boring. Real wealth is built in decades, not days. Let me give you a concrete example. Let's say you are 25 years old. You invest $500 a month into a boring, diversified market index fund. You do this every month, rain or shine. You never sell. You assume an average return of 8%. By the time you are 65, do you know how much you have? You have over $1.5 million. But here is the kicker. You only actually put in about $240,000 of your own cash. The rest, over $1.2 million, is free money. It is the result of your money making babies, and those babies making more babies. That is compound interest. But beginners interrupt this process. They get scared and sell during a crash, or they get greedy and pull the money out to buy a fancy car to impress people they don't even like. When you interrupt compounding, you kill the magic. As Charlie Munger, the partner of Warren Buffett, famously said, the first rule of compounding is to never interrupt it unnecessarily. So we have talked about the disasters. We have walked through the valley of the shadow of debt. Now, let's climb the mountain. How do we avoid these mistakes? How do we build a strategy that is bulletproof? I am going to give you a 5-step framework. This is the MonsterInvest Survival Guide. Step 1. Define your why and your time horizon. Before you buy a single share, ask yourself, when do I need this money? If the answer is in 6 months for a down payment on a house or next year for a wedding, do not put it in the stock market. The market is volatile in the short term. It can drop 20% in a week. It is a voting machine in the short run, but a weighing machine in the long run. Only invest money you won't need for at least 5 to 10 years. This eliminates the panic that Alex felt. If the market crashes tomorrow, you don't care because you aren't selling for 10 years. You have time to wait for the recovery. Step 2. Build the safety net first. This is boring but essential. You need an emergency fund, 3 to 6 months of living expenses in a high-yield savings account that is liquid. Why? Because life happens. You lose your job, the car breaks down, you have a medical emergency. If you don't have cash, you will be forced to sell your investments at the wrong time, usually when the market is down, to pay the bills. Your emergency fund is the shield that protects your investment portfolio from life's chaos. Step 3. Accept that you know nothing, the Socrates approach. This is the antidote to Sarah's overcomplication. Most professional fund managers who went to Ivy League schools have access to Bloomberg terminals and have armies of analysts cannot beat the S&P 500 over a 10-year period. If they can't do it, what makes you think you can do it by reading a blog post in your underwear? Instead of trying to find the needle in the haystack, just buy the haystack. Buy the whole market using low-cost index funds or ETFs. You instantly achieve diversification. You own a piece of every major company. If one goes bankrupt, you don't feel it. If one discovers the next big technology, you profit from it. You are betting on human innovation and the global economy, not on a single CEO. Step 4. Automate your discipline. We are emotional creatures. We are terrible at making logical decisions when money is involved. So, remove the decision-making process. Set up an automatic transfer from your checking account to your investment account every single month on the day you get paid. Treat it like a tax. It leaves your account before you even see it. This is called dollar cost averaging. When the market is high, your fixed amount buys fewer shares. When the market crashes, your fixed amount buys more shares. You automatically buy low and sell high without even trying. You turn the volatility into your friend. You stop checking the price because the buying happens automatically. Step 5. Master the art of doing nothing. This is the hardest part. Investing should be boring. If you want excitement, go skydiving, go to a casino, go watch a horror movie, but for your life savings, you want boredom. When the market crashes, and it will crash, I promise you, it happens every few years, your job is to do nothing. Do not check your account. Do not sell. Do not listen to the news anchors screaming that the world is ending. History shows that every single market crash, the Great Depression, the dot-com bubble, the 2008 financial crisis, the COVID crash, has been followed by a recovery and new all-time highs. The only people who get hurt on a roller coaster are the ones who jump off while it's moving. Stay in your seat. I want to pivot for a moment and talk about one more specific trap that I see in the modern era, which is the influencer trap and survivorship bias. In the age of social media, everyone is a financial expert. You will see TikToks and YouTube videos promising 100x returns, or the secret strategy Wall Street doesn't want you to know. You look at these people and they seem successful, but remember survivorship bias. You are only seeing the one guy who got lucky and won the lottery. You are not seeing the 10,000 people who tried the same strategy and went broke. They don't post videos about their losses. Please hear me on this. If someone actually had a secret strategy that generated guaranteed massive returns, they would not be selling it to you for a $19.99 monthly subscription fee. They would be on a private island, keeping it to themselves. Most of these gurus make money from selling courses, not from trading. Do not outsource your thinking to strangers on the internet. If you don't understand an investment, how it makes money, what the risks are, what the moat is, do not buy it. As Warren Buffett says, never invest in a business you cannot understand. Let's go deeper into the psychology of loss aversion that we saw with Ben. Scientific studies by Kahneman and Tversky show that the pain of losing a dollar is psychologically twice as powerful as the joy of gaining a dollar. This is why we hold on to losers. We are trying to avoid pain. To combat this, you need a thesis. Every time you buy an asset, write down on actual paper or a digital note why you bought it. For example, I am buying Company X because they are the leader in cloud computing. Their revenue is growing 20% year over year, and they have no debt. Then when the stock drops, you pull out that piece of paper. You ask, is this thesis still true? If the revenue is still growing and they are still the leader, but the stock price is down simply because the whole market is down, then you don't sell. In fact, you might buy more because it's on sale. But if the thesis is broken, if a competitor stole their market share or they have massive debt, then you sell. You sell regardless of the price. You base your decision on the business reality, not the stock price. This disconnects your emotions from your money. We are coming into the home stretch of this episode, and I want to talk about the most important asset you have. It isn't stocks, it isn't real estate. It isn't crypto, it isn't gold. It is your human capital, your ability to earn income. The best investment you can make as a beginner is often in yourself. Increasing your skills, getting a certification, learning to negotiate a higher salary, or starting a side business. If you can increase your income, you can increase the amount you invest every month. Remember the compounding example. If you invest $500 a month, you get $1.5 million. But if you can get a raise and invest $1,000 a month, you don't just double your result. The compounding effect accelerates even faster because you have more capital working for you earlier. Don't spend all your time analyzing stock charts. Spend some time analyzing your career path. That is where your cash flow comes from. And be careful of lifestyle creep, where your spending rises as your income rises. If you get a raise, save the difference. Don't just buy a more expensive car. So we have covered a massive amount of ground today. We have traveled from the emotional highs of the hype cycle to the despair of the market crash. We have looked at the math of compounding, the friction of fees, and the psychology of loss. Before we wrap up, I want to summarize the key takeaways. If you were driving or working out and missed some parts, here is the cheat sheet. Here is what you need to remember from today's episode to protect your financial future. Number 1, eliminate FOMO. If you're buying because you are afraid of missing out, you have already lost. True investing is about value, not hype. If everyone is talking about it, it's probably too late. Number 2, avoid analysis paralysis. You don't need a complex system with 6 monitors. A simple, consistent strategy of buying the whole market usually beats the experts. Simplicity scales, complexity breaks. Number 3, don't anchor to your purchase price. The market doesn't care what you paid for a stock. Make decisions based on the future of the business, not the past of your portfolio. Learn to cut your losers. Number 4, think in decades. Ignore the daily noise. The stock market is a device for transferring money from the impatient to the patient. Be the patient one. Number 5, automate everything. Use technology to save you from your own bad habits. Set up automatic transfers and let the system work for you. Willpower is a limited resource. Automation is infinite. And finally, number 6, invest in yourself first. Your greatest wealth building tool is your income. Grow your shovel so you can dig a bigger hole for your treasure. Investing is not about beating the market. It is about controlling yourself. It is about mastering your own psychology so that you can let the incredible power of global economic growth work for you over time. It is a marathon, not a sprint. And in this marathon, the winner isn't the one who runs the fastest. It's the one who refuses to stop running. Thank you so much for spending this time with me on MonsterInvest. I know your time is valuable. It is the one asset you can never get more of, and I appreciate you trusting me with it. If this episode helped you, if it gave you a moment of clarity, please share it with a friend who might be about to make an Alex mistake. Let's help them out. And if you want to support the show, please take a second to hit that like button and subscribe to the channel. It really helps us grow and reach more beginner investors who need to hear this message. It costs you nothing, but it means the world to us. I'm Daniel. Keep your head cool, keep your fees low, and keep your vision long-term. I will see you in the next episode. Goodbye.